Hello, class. Welcome back. Last time we talked about Markov properties. We talked about winner process, and we then, from winner process, we built a ethos process. Now, in this class, we're going to talk about how we apply that. So essentially, how we're going to use ethos process to build a stock price process. So a stock price process is very important for us because, well, for that matter, the process of any underlying variable is very important for us. And we're gonna build a process, a good process for us to use, and so that we can utilize it to price our derivative asset easier. So, but what does it mean? What is a good process for stock? Well, when we do that, we don't want this process to be too complicated. Yet at the same time, we want this process to have enough structure such that it does capture the essential dynamics of the movement, the market movements. And also, if we're lucky, then we may also want to have a process that somehow gives us a closed form solution for the derivative product that is built on top of this underlying asset. So for stock per se, we know the stock prices follow some stochastic process. They're stochastic in some way, i.e., they're not totally predictable, not totally deterministic. So we can utilize ethos process to model that. So, however, then we want to have certain structure on the drift term mu and the volatility term sigma here, such that they are not too complicated. Like the function here is not a overwhelmingly complicated function. Yet we don't want this to be too simple. Now, what do I mean? So you can, if we really want to be simple, and we can have a very simplistic process here, where if we label as the price of a stock, then we can say this the price of the stock follows a ethos process in the following way: ds is equal to mu dt sigma dz. Here, mu and sigma are just two constants, okay, two different constants. They're not a function, there's a constant function. They're a constant function. Now the question is this a good process for stock price or not? Well, you may want to pause and think about it, because the answer to this question is that it is not a good process for stock. And the reason for that is, if you look at this one here, this process allows the stock price to be negative. So, and why? Because here, mu is some, say, number, say positive, some positive number here. So if there's no random terms here, the stock is expected to increase over time, the stock price. However, if you here dz can give you some large, can give you negative numbers here, and you have a relatively large sigma here. It has a high, volatility, and if that volatility is really high, you can actually overwhelm the first term here. So, and then the overall change of ds can be negative. That's fine, but the change of the stock price can be negative. But what you don't want to happen is the overall stock price itself to become negative. So if you actually integrate this stochastic differential equation here, you actually find that the distribution of stock follows a normal distribution, and and that it has a sizable mass under the distribution that is actually negative. Now, we, however, typically don't think that stock can become negative, because what's the worst case? The worst case will be that the company has gone bankrupt. So if you are the holder of a stock, you'll probably lose all the value that you invest. However, that's, you're not gonna owe any more than that. So if you spend $100 by a stock, the worst case is that you lost that whole $100. But you typically would not need to pay another 100, 200, 300, whatever that value is anymore. So having a negative stock price is probably not the reality. Of course, that if you're not modeling the stock price, you're modeling other things. Sometimes you can actually have negative values for those things, although typically not very often. But you do see some strange things happening, especially some strange things that has happened lately, right? If you've followed the market closely or relatively closely, you'll see that the actual futures price for crude oil has actually just gone to below zero. So the May futures has, become somewhere around negative $37 per barrel. So, which means that certain things that you may typically think that probably was not going to be negative could become negative. However, that is not really the norm. So if you particularly for stocks, because the nature of limited liability company means that you're not going to have any more liability than the initial investment you put in as a stock holder of a company. So if you model on stock price in this particular one, the underlying distribution of stock can have a large area in the negative territory. So that's probably not a very good process we use. Instead, if you use a process like this, ds is equal to mu s dt and plus sigma s dz, then you will see that after you integrate this and look at the distribution, you will actually find this the distribution would not have any area in the negative territory. So in this case, if you model the stock price this way, with this process, the stock price will never become negative. The S itself could be negative, but as S becomes smaller and smaller, and you have a negative shock here, the DS will be a smaller and smaller negative number. And that's where you have the S here. So, which means that in the limit that even actually the stock could drop too close to zero, but you'll never really go across that particular point. So you will never become negative. So let's look at some of the so I've here a blue line and an orange line here. So one is simulated, one is the real stock price index. The simulated one is based on a particular ethos process with a calibrated drift and volatility, meaning a calibrated mu and a calibrated sigma here. The reason I'm putting it here side by side is, can we distinguish which one is the real stock price index, which one is the simulated one based on a stochastic process? Now, if you have a relatively good stochastic process for stock, that process shouldn't be easily distinguished from the real one here. So, you may take a guess on which one is real, which one is simulated, and see whether you spot them. So here I've done it, from 56 to 1979. Now the next one has a more recent history here. It's from 1979 to really before year 2000. So again, blue is still the same blue one as in the last slide, and orange is still the orange in the last slide. So now does it, with this new information, does it change your guess which one is which one is simulated and which one is real? Now let's look at some more recent information here. I didn't plot anything beyond 2017. I could, but it doesn't really give us a whole lot of value here. So again, this is some more recent information of one is the simulated, one is the real market index. Now, if I put everything together, you probably can now spot which one is the real one, because the real one has a very characteristic feature, and that feature, it's not inherent in the sense that any real one must have that. So the feature I'm referring to is really this double tops here. So the one we're looking at, this one is really the tag bubble. And here, this is right before the 2008 financial crisis. So if you have invested, you would have made a lot of money up to this tech bubble here, and it drops substantially. Then it comes back. So the market continued again to be quite hot, and then it reaches almost the same point. So it didn't really go above. So basically this period of time, if you bought stocks here, you spent like almost an entire decade to come back to the same point. Then it drops again. So it's kind of frustrating in that sense. But then after the financial crisis, the market recovered very strongly, and actually then surpassed quite substantially from this level, the highs at the before the 2008 financial crisis. So the blue one is really the S&P 500, and the orange one is a simulated one with the calibrated mu and sigma here. So if you really look at it, people probably will think that the orange one is actually more quote unquote likely, or be like a real one, because typically structures like this, why, right? Well, why do you have something like that? This is more a peculiar aspect of that than so you're probably not gonna see that every 10 years things will happen this way. So again, we can see that the orange one is a fairly good representation of the stock market is. Okay, I'm gonna stop here, and we'll see you next video in the next video.